How's it going today, everybody? Just wanted to get in here and see what you guys are up to. I got to share my screen. Let's see. There we go. Hopefully you guys can see this. All righty. I'm going to give everybody a chance here. Let me see if I can figure out Facebook real quick. Facebook was being difficult a minute ago. So trying some new things here, wanting to try different times of the day, but I got called into work today, so I had to do that to cover some people, and that's why I'm getting a late start on it today. But I've got this was one of our underwriting that we did for a project that we've got under contract, and I'm having a difficult time right now getting everything squared away on Facebook. I'm going to need to get somebody to make this quick click and share. You know what I'm saying? Because this is just driving me absolutely nuts. I can't get Facebook to ever work for me when I want to go live. So that's okay though. We're gonna bounce back. Just see, you guys are awesome. You guys put up with a lot of my technical difficulties. I need to get Giovanni on here and have him set me up with one click live and everything. So I'm going to text him real quick and remind him. Hopefully everybody's joining me right now. Oh, I'm going to turn this down because that's going to get a lot. So I hope everybody can hear me. I better double check those messages. Last time I was getting this kind of messages, everybody couldn't hear me. So can everybody hear me? Can you put comments down put a comment in there? Just let me know if you guys can hear me. Anybody on here? We got 6 people joining right now. So that's amazing. All righty. You guys are awesome. Thank you for joining me. This is my underwriting. We're looking at a property that you guys need to be able to underwrite quickly. That's the whole goal of this training right here is to figure out fast. You guys need to make decisions fairly quickly whether you're going to want to buy a property or not, because the properties are going fast. They don't sit on the market very long. So this is a property that we actually got on Facebook Marketplace. Giovanni went over and talked to the gentleman and went and looked at the property, and it came back that the property was an amazing property, and Giovanni was very happy to negotiate this property. So I guess I'm going to jump right into it. So when you're starting to do underwriting, when you're looking at a property, you have a couple of different things that you need to start looking at. You have to make some decisions based on this property fairly quickly, and because you need to get it under contract as quick as possible. So I'm going to jump right in on this. The first step is you got to set the rules. Okay. You have to go into this knowing what you're looking for. You got conservative assumptions. So you're looking at what the real taxes are, what your insurance is, and you're using in-place rents. So notice I say in-place rents on this. In-place rents are what the actual tenants are paying right now. And a lot of times when you're buying these properties, you're getting them from mom and pops who are burnt out on being a landlord. So they don't really usually raise rents very quickly. So more than likely the in-place rents are probably way under market. So that's why I do that. And then you have to decide whether or not the tenants are paying utilities, because that's a big expense. If the landlord pays utilities on a property, that can turn into a huge expense, because you have you have a set budget, okay, and all you got is your rents coming in. When the whole goal of this is not to be putting your own money into a property, and you have to determine when you're doing it whether or not you're going to have to put your own money into a property. And the ultimate goal is not to do that. So, and then you make these decisions fairly quickly. We're going to go through this very quickly, but that's the whole goal. You include the management, repairs, and capex fudge factor. So I go back to the fudge factor. So with the set rent, okay, generally I always figure in 10% for a management fee, which is property manager, because you don't want to create a full-time job for yourself. I mean, you've got a full-time job, but you don't want to get a side hustle, passive income that's going to be a full-time job. That's not what you are trying to accomplish here. I mean, it could be if you want to. That's something that you can do. So I definitely would recommend that you learn how to do property management, because I learned how to do property management back in high school, just out of high school. And it was a situation where it served me well through my entire life, because you know exactly what the property managers are going through and you know what it takes to do the job. And you have to understand, before you can lead people, you have to understand what it takes to do the job. I'm a big proponent of managers getting down in the trenches with the employees, and anything my employees do or I'm expecting them to do, I'm prepared to jump in and help and do that myself. So you include the management, you include any repairs that are needed right out of the gate. So if you walk up and there's problems with the basement wall, or problems with the roofing, or problems with siding, gutters, anything like that, you have to factor that in, because you don't want to be surprised. And this is your initial underwriting. This is what you need to get in order to make this a good deal. So you have to have these numbers down cold. You need to know exactly what you're doing. And then the capex fudge factor. I always like to throw 2-3% of the monthly rent in for a fudge factor, and that's not for the life of the property, but it could be. I've had it go 1-2%, and then I just put it into my reserves. So that's another factor. You just put that in there, and I'm going to get into the numbers here in a minute. I printed up all the numbers and got it all set. And the last one here, this was something that I felt that you guys had to have. So if it only works when you have perfect vacancy expense ratios, then you need to walk away, because perfection is not something that most of us will ever achieve. So if you're looking at, so say pro forma. So what a pro forma is after you stabilize it, the pro forma numbers are what you can get in a perfect situation. That's after all the repairs are done, after all the rents are stabilized and everything. And my best analogy of that is, say you're getting married. Okay, Sonny, one of my partners, actually, Sonny had said that he was getting married. So say Sonny was getting married. He's got $2,000. He wants to go buy like a world famous cake. So he goes and gives the people $2,000 for the cake, and they hand him all the ingredients to make the cake, and they tell him to go make the cake. That's what people selling properties on pro forma is. They're telling you this is what you can get for the building after you do all the repairs. If that's what I can get after all the repairs are done, you do the repairs and I'll buy it after the repairs are done. If the repairs aren't done, that's not what I'm paying for it. Okay. That is something that you have to remember. You're not paying for a cake and getting eggs and flour and sugar and that sort of thing. So that's very important. Okay, let's jump into the numbers on 7 Chapel Street. This has been under contract, and we're in the middle of doing the due diligence right now, which is a matter of finding out what all the expenses are and actually going through them and making sure that what we were told the expenses are is what the expenses actually are. Okay, so the first thing we did, we negotiated a purchase price of $159,000, and we went back and forth on the purchase price. The owner of the property had some things that he wanted to accomplish. He needed to get this set, and he has another house that he needs to pay off, and just a lot of stuff going on. I'm not going to get into his story. That's his story. If he wants to share it, jump in and share it. So the purchase price was 159,000 for a 3 unit, which it's rented, but the market rents are under what they should be. So we've got 2 apartments that are $1,000 each, and 1 apartment that's $800. And you'll see that farther down here. The down payment we negotiated was $30,000. That was pretty hard. I didn't want to pay $30,000. We tried to get it for no money down. We tried to have him hold paper and finances on the $30,000. We actually tried to offer to pay the other house off. So real estate, you can get very creative, and that's what the whole idea of creative financing is. You can get very creative with real estate. So he had another house he wanted to pay off. That's what he wants to use this $30,000 for. We offered to assume the debt from the other property, pay the other property off over time, and use that as our $30,000 down payment. But it ended up, I mean, it was a great idea, and it's worked for me before, but it's not going to work in this instance because he just really wants to get it paid off. So his wife is all set. So the actual loan amount is going to be $129,000. We got it negotiated for 7% owner financing. The guy's going to hold paper on it. So, and anybody that's telling you that you can't do owner finance right now is just wrong. They just don't understand how owner finance work. If they tell you that you can't get a property with owner finance, Giovanni and I are finding properties all the time that are owner finance. So you just got to not be afraid to be told no. So you got to get out there and you got to look for these properties. Now, we got it at 7% interest, 30-year amortization. What a 30-year amortization is you're going to take the 129,000, you're going to divide it over 30 years. So it's like the mortgage is going to go for the entire 30 years, add the 7% interest for the whole 30 years, and that's what your payment's going to be monthly. Okay. And the guy wants to kind of cash out faster. He started off with a 2-year balloon payment, and Gio and I started out at a 5-year, or actually it was a 10-year balloon payment. We ended up negotiating back and forth, and we got to a 4-year balloon payment, which a balloon payment is we're going to make payments at 30-year amortization total for 4 years. And then at the end of the 4 years, the last payment of the 4th year, the next payment, we have to refinance out of this and pay the entire balance off. So that clears him out, and it gets us a different mortgage probably with a bank or a private lender. We haven't decided. We've still got 4 years to get this stabilized, and we can figure it out on the way. Okay. So here's the rents. The current rent's 2 at $1,000, 1 at $800. That is below market value rent in Seneca Falls. That was one of the things that we needed to go over was we have to figure out what other people in that area are paying for similar properties. That being said, it's one of those things that you should be able to come up with those numbers fairly quickly because it's printed everywhere, honestly. But just a simple Google search, or if you've got a real estate agent that you trust, that you can get those numbers from him. Taxes on this property, $5,000 a year. The insurance roughly is about $1,400 is what we were factoring in. I haven't bothered Ron, our insurance guy, yet because he's been so busy with all of our other properties and everything that until we got it under contract, I usually can do a pretty fairly accurate job of estimating it based on our other properties. It might go up or down 100 or 2, but that's what the fudge factor's for. So I can kind of make some assumptions based on experience, based on intuition, and that sort of thing. And I'm very rarely incorrect. I'm not tooting my own horn on that. I'm not being pompous. I'm not being egotistical or arrogant. It comes from having done it for so many years that I can just tell you where we're at for a lot of this stuff. Okay, so we're starting with the rent reality checks. This is where we start out with our underwriting. So we have to use the actual rents, and I want to get a baseline number for the actual rents to make sure that once we take it over, if we don't get it stabilized right away, we still got to make the payment on this property. The homeowner gets the payment first. Okay. Once they get paid, then everything else happens. Everything else can happen down the road. We can stabilize it. We can get everything squared away, and we can go farther on down to raising rents, and then figuring out how we're going to make additional capital. Okay. So the baseline in place gross rents right now are $2,800 a month. That's $33,600 per year, which sounds like, I mean, that's a decent return on your investment if you had no expenses. So that's what underwriting is. We're taking that $33,600. That's the income we're getting for this property per year, and we have to subtract all the rents and all the expenses and and everything out of that number. That's our top line baseline. That right there is what in place rents are getting right now. Okay. Since and basically we're not going to assume any rent growth right now because we're just using the baseline rents based on what the folks have been paying. So that's one of those things that eventually we will figure in rent growth, but you can't do it underwriting. I want to go baseline. I want to know, taking this over, if I cannot raise rent, and if you raise rent, there's always a chance that some tenants may move out. So you have to make sure that the fudge factor and everything lines up. Okay, the tenants in this one pay the utilities, so there's no owner utilities assumed here. Let's see. Okay, no, step number 4, we have to underwrite the income like we're an operator. Okay, and what an operator is somebody that does this, like I'm an operator, Giovanni's an operator now. We do this is what we do. We eat, sleep, breathe real estate. An operator is somebody that knows their numbers cold, and they can go in and they can do all of this. This entire sheet that I'm doing, I'm kind of breaking it down for you, but I took these numbers and ran them through in my head, and I had an answer about whether this was a good property or not based on the numbers. When I first ran them through in my head, it was not. It was a good one. It was a good deal, and I'm kind of cutting to the end a little bit. We got it under contract, so you guys have to know that it was a good deal. But it started out being a less good deal, and then you just negotiate your way into a good deal. Every deal you can salvage, well, generally, as long as you got a reasonable seller. Okay, so we've got a gross rent of $33,600. Then you have to take the vacancy credit loss. Okay, so in a vacancy, what a vacancy is, I always like to factor in my vacancy rate, which means 5% of the time one apartment is going to be vacant. So we're figuring we're going to lose about $1,680 per year on vacancies, which is turnovers. People move, people just stop paying rent, and then they have to be evicted, just different things like that. And hopefully we're inheriting 2 of the tenants. The third tenant is hopefully getting evicted, but I'm not sure where we are with that. So I'm not spreading misinformation because I just don't know. So we're looking at $1,680 per year. We're losing to vacancy rate. You have to factor that into the vacancy rate. And can somebody let me know? I'm looking on YouTube. Is everybody good here? Is everybody following me? Okay. Anybody have any questions on this information? Because I'm not trying to go too fast for you. I want to make sure I cover it in detail, because these are things that you need to learn. You have to have these numbers down cold. So, okay, if everybody's good, we're going to carry on. All right, sounds great. Okay, so we're losing $1,680 per year to vacancy rate, which drops our effective gross income, EGI. That's down to $31,920 a year. So now we're factoring in that we're going to be making about $31,920 after we get rid of the vacancy rate. Okay, so that's not horrible, but as you can see, as we go through this underwriting, our number is going to be whittled away. That's the whole idea of underwriting, is to find out what the final number is after we whittle it away on everything that this property has got going on. Okay. All right. Step number 5 is a big one. Okay. This is expenses you can't ignore. These are expenses that you actually need to have on most properties. So you have to factor them in. Like the first one there, property management. If you're going to be doing your own property management, you still have to calculate 10% property management, or else you're buying a full-time job that you can't get out of. Okay. So you have to factor in 10% for the property management, because you may not use it. Okay. Then if you don't use it every year, you don't use it, that can go into your reserves. So that's $3,360 that can go into reserves every year. But it's there. So when you decide, I've had enough of this fun, I've had enough of tenants, I just want to retire and go to Florida. Okay. Then you've already calculated the 10% management fee. So you just use that money, put it right in there, and it doesn't hurt you at all because you've already calculated it and you've thought ahead. So that's important. Okay. Make sure you're always planning. You don't want to plan for where you are right now. You want to plan for where you want to be. And in 10, 15, 20 years from now, you want to be retired somewhere on a beach. I'm assuming that's where I want to be, my camper on a beach. Down below, let me know, what is your 10, 15, 20-year plan? Where do you want to retire? What do you want to have happen? Do you want to never retire? Let me know down in the comments, because I'm curious, because I want to know if your plans include beach and camping. So that's where I'm at. Okay, let's move on to the next one. Okay, so we've got the property management, repair reserves. So 5% of the gross rent, okay, 5% of that gross rent is for repairs. So I always like to put $1,680 a minimum away for repairs. Now, whether you use it or not, that's one thing. Okay. Now don't confuse repairs and CapEx. Okay. So repairs are regular maintenance, regular run-of-the-mill repairs, leaking faucets. You need to put gutters back up, things like that. CapEx is, I need a brand new boiler. I need a brand new furnace. I need a brand new roof. Capital expenditures are stuff that actually goes wrong with the property. That's a bigger project than just, I had to call a plumber. Okay. So that's what CapEx. So the first one is, I put 5% of the gross scheduled rents away for your repairs. So that's $1,680. It doesn't sound like a lot, but if you're doing the proper due diligence right now, then a lot of the problems can be accounted for and fixed before you even take possession of the property, hopefully, which means that you won't have a lot of you won't have a lot of repairs. So that 1680 should pile up and compound into a nice reserve. Okay. So that's one thing you have to take into account. The CapEx fudge factor, I always do 2% of the gross scheduled rents, because that's $672. You can use the repair budgets for CapEx, but I always like to have that 2% extra for CapEx. So as you can see, we're whittling it away. Next is the taxes, $5,000 per year. That comes out of your gross rents for the whole month. So you have to factor that in, because, as you guys know, Uncle Sam's going to make sure he gets his fair share, and he's going to take it right off the top. And that's one of those things where you could easily lose your property if you're not doing what you're supposed to do, as far as the government and the IRS and property taxes and school taxes and all that. So you have to factor that in. That's part of the deal. Okay. Insurance, I've already got down for $1,400. So total operating expenses. Now the insurance includes liability, fire, damage, wind, flooding. If you need flooding, if you're in a floodplain, we are not with this property. This property is just going to be hazard insurance, liability insurance, that sort of thing. So the total operating expenses were the $3,360, which was the management fee, $1,680 repair reserve, $672 for the fudge factor, $5,000 taxes, and $1,400. So that's a total operating expenses, as I underwrote them, at $12,112 per year. Okay. So we need to calculate the NOI, which is the net operating income. Okay. The net operating income is the $31,920. Now remember, that's your rent after you take away your vacancy. Now, that'll be higher if you don't have any vacancy. You always factor a vacancy. So let me grab a real quick drink here. Oh, okay. So are you guys following me? I want to make sure everybody, I hope you guys are all good, because I'm moving fairly quickly through this, but I can answer questions. If you have any questions, leave them in the comments and I will be more than happy to sit down and I will dive deep into this. This is giving you a preview of what an underwriting is all about. Okay. So let's do that. All right. Okay. So we're taking the 31,920, which is your income, your income, gross income after your vacancy rate, subtracting out the total operating expenses of 12,112, and that's net operating income of 19,808. That's what we're expecting to make on this property per year, based on the rents are actually in there. And as long as everybody continues to pay their rent, we're going to be in good shape. Now, that's net operating income. We're going to make roughly $1,650.67 per month. So that's per month net operating income. Okay. 1651. Next, that's the amount of money that we have available to pay the debt service coverage. Okay. Using the actual loan terms. So the loan amount is going to be 129,000 at 7% interest, amortized over 30 years. So the monthly payment, and we negotiated this. I accidentally forgot. Well, I didn't accidentally. I mean, I forgot completely that the seller negotiated. He wanted at least $1,000 per month for the monthly payment. So these numbers are a little off, but you're looking at monthly payment, principal and interest of, we'll say $858 for the sake of these numbers, but it's actually, he negotiated $1,000. So he wants $12,000 annual debt service coverage. Okay, so that's about another $1,800. So we're saying the debt service coverage ratio, and now listen, a good debt service coverage ratio, and that's the amount of money that you have left over after your service is covered. So our debt service coverage ratio is 1.92. It's 19,808 in net operating income divided by what the debt is. So we'll say, and let me do the math real quick. Let me grab my calculator here and just bear with me 1 second, and I can tell you what the actual net operating or the debt service coverage ratio is for ours. So we got 19,808 divided by 12,000. So it's a 1.65. So we allowed the owner of the property that's holding the paper to take us from a 1.92 debt service coverage ratio down to a 1.65. Now, mind you, a strong DSCR is 1.25. So we're doing very well on this property. Okay. So the cash flow after the debt before any extra of our cost is roughly $792.67 a month. That's our profit before any of our, that's the actual cash flow. Okay. So that's the cash flow that we're getting from this property is $792. I'll round up. We'll say $800 a month is what we're making profit on this. There's 3 doors. So that's almost $300 a door profit. And if you can make usually $100 a door is a good profit. If you can make $300 a door for profit, you take that all day long. It's just a no-brainer. And then the balloon. Okay, so I did a reality check. Okay, the 4-year balloon payment sounds intimidating. I needed to address it here because I wanted you guys to know that the balloon payment's not really horrible. Okay, so we've got $129,000 is the debt. After 4 years, 48 payments, we're looking at about $123,000 is what we'll have left to pay on it. So then we turn around. By this time, we've got it stabilized. We should have the property value should be up to, I would guess, probably 160, 180, somewhere in that range. It's going to be even higher. So we go into it with a little equity because we paid the $30,000 down payment. Okay. So in year 4, we're going to need to refi or pay it off about 123, 120. Okay. So the safety that we have is the stable net operating income, which is the 19,808. Excuse me, the 9,512 or $800 per month is a good stable net operating income, which adds to our refi options. So we can do the refi options. And then we've got, by this time, we should have a huge amount in reserves, $30,000-$40,000 in reserves. So we probably wouldn't even need to refi the whole 120,000, because generally speaking, I'm okay using half of our reserves for a refinance. So we should be able to throw $15,000-$20,000 towards it based on the reserves that we were able to sign up or save up. Okay. And then I usually do a stress test, which, I mean, I added it here, but that goes really, it goes really in depth, which for new investors is kind of deep, but I'll go through it fairly quickly. So we're going to use the real numbers. The baseline is the net operating income, 19,808, debt service coverage ratio, 1.92, and a cash flow about $800 a month. We got the vacancy rate of 2%, 5 to 7%. So I add the 2% on to the vacancy rate just to make sure that we can still cover it in case our number is off. Okay. So the extra vacancy is going to hit differently. Okay. We've got 33,600 times 2. That's 2%. Okay. So we're going to get down through here. The new cash flow after we add the vacancy rate is about 737. So we only lost about $60 adding 2% of the vacancy rate on. Okay. So that's not bad. It drops the debt service coverage ratio down to 1.86. Okay. So it's basically taking $672 off of the income. All right. So the cash flow is 737 a month. So we're going to add on 10% to our operating expenses. So take the 12,112, which is what we were at for our operating expenses, multiply it by 1.10, which is adding 10%. Okay. So we've got 13,323.20. So what a stress test is, sorry, let me grab another quick drink. I love talking, and I hope you guys are all following with me. Are you guys all still here? So what a stress test is kind of throwing different numbers on there as a worst case scenario type situation. So we're adding 2% on for the vacancy rate, which drops it down, to 736. So we're taking that 737, we're adding 10% onto the expenses. You never know, maybe siding fell off, or something happened that's adding 10% on. So that's increasing our operating expenses to 13,323. New net operating income is the 31,920 minus that 13,000. So we're looking at 18,596. Worst case scenario, adding 10% on. Now, the 10% is we're doing all this hypothetically. This is stress testing it because I need to make sure that if everything goes sideways, that our numbers are still okay. That's what you're doing. And I did all this in my head fairly quickly, and you will be able to too. This is something, and believe me, when you're doing it in your head in 2.5 minutes, it's very difficult to sit down and write it out this detailed. So, okay, new debt service coverage ratio is 1.81. That's after 2% increased vacancy rate and 10% additional expenses. So we're still, even with 10% and extra 2% vacancy rate, we're still at $691, $700, which is still over $200 a door profit. That's really good. Okay, cash flow. So the cash flow, we're looking at 692. Now, say the guy comes back to us and he renegotiates 1% additional interest rate from 7 to 8%. That means the new payment on the property is going to be $947 a month, which is up from what it was previously. So the annual debt service coverage ratio goes up to 11,364, which we were already at 12,000. So, I mean, that's a 1.74 debt service coverage ratio. So we were at 1.65. That's going to drop that down to about 1.5 probably. When we stress tested, that's what I had in my head. So the new cash flow is 703.67 a month. So even with the worst case scenario, stress test and everything, we're still going to be making, if things go sideways, we're still going to be making $704 a month on this. Over $200 a door, 233.33 to be exact, somewhere in that neighborhood. Okay. Bottom line is this: even with the stress testing, the debt service coverage ratio stays above that 1.25 that I talked to you about earlier. Cash flows stay positive. Everything stays positive. So we're in good shape on this property, even if things go a little sideways, which inevitably, like I said, the fudge factor, things are going to go a little sideways. Okay. So this deal works on the in-place rents with conservative reserves and property management. We're including property management. We're not going to use property management right out of the gate. We're going to have a few months where that's going to increase our net operating income. Okay. So, and basically buying or negotiating is what I was talking about earlier. So you're going to buy it if the math says yes. So the units, rents are verified, leases, payment history, everything's verified. That's what we do during due diligence. No hidden owner, paid utilities, deferred maintenance, anything like that. So that's why we have to get in there and do the lawyers are handling the due diligence. And we have to have a plan in place for refining in 4 years, because we need to make sure that this part of the contract, they could actually force a sale if we do not refinance it in year 4. They could force us to sell it and then make them whole, and we would have to take, we would get profit, but we'd lose out on $800 a month net income. Okay. What we would need to negotiate, if the inspection, or like when the lawyers start doing the history, if they reveal high repairs, roof mechanical risks, rent collection issues, say they said all the tenants are paying on time, and we find out that this tenant's 5 months behind, that's something that they did not disclose to us. So we have to go, it's called retrading, renegotiating, however you want to say it. But we can go back and renegotiate the contract based on actual real world scenarios. We can push the balloon out longer. We can get a lower rate. We can get a price reduction. There's just so many options for when you're trying to retrade something. If you find a discrepancy in what they say that the things were and what they actually turn out to be, then you can negotiate better pricing. Okay. Don't think that you have to stick with the contract. You can always retrade it and get back into making it a profitable one. Okay. So basically, on the numbers, this is a cash flowing triplex with a 1.9% debt service coverage ratio at 7% owner financing. Okay. I love this deal, and it's important that you guys understand why. Everything is coming up basically roses on this deal. None of even the in-place rents, and I can tell you right now, the in-place rents even are below. So these numbers are just going to get better because we're going to raise rents to market rents. So the only real question that I haven't answered is, are we going to refi in 4 years without getting crushed? Yet we don't know what anything is going to happen. We don't know what's going to happen in 4 years. We don't know where the interest rates are going to be. We don't know what the market's going to be. But that is less concerning to me. And this is why I put this in here. It's less concerning to me because we're buying for cash flow. We're buying for net operating income. And I've told you guys several times, net operating income, that cures a lot of problems. So if we miss something, as long as we underwrite it and make sure that we're underwriting it for the net operating income, that's the money we got coming in. As long as our net operating income debt service coverage ratio stays at a 1.92, in 4 years, it's going to be, I'm not going to say it's going to be immaterial what the interest rates are doing, because that will affect one way or the other, but it's going to be less stressful. We've already stress tested increased in interest rates by 1%. If it triples, if the interest rates goes from 5% to 30, That might affect it a little bit, but at that point, we can probably turn around and sell it as owner finance and renegotiate with the seller, let them know that it's not good to refinance and just try and negotiate, because you always want to be upfront with everybody. Everybody involved in the deal, you just need to be upfront with them, and most generally, they'll want to help you out as much as they can. Like I said, once you tell people you're a real estate investor, they generally want to help. Okay. This is one of the things that I'm letting everybody know on YouTube Live. If you guys have a deal out there and you want me to do this kind of analysis with you or for you and walk you through it because you're a hands-on type person and you want me to do what I just did for my deal to your deal, let me know. Put it in the comments. Give us a breakdown. Drop your rent, prices, taxes, everything, and we'll get you on a Zoom call. We'll break it down. We'll put it on YouTube, and we'll help people learn how to do this the right way, because these are things you have to master. And the way to master this is you got to do the reps. You just got to learn how to do it. You got to jump in there and you got to get it done. That's where you learn. So I hope I answered everybody's questions. If you guys have any additional questions, throw them in the comments on the YouTube video. The live it's been a good give and take on the live. I haven't really seen anybody talking too much, but I'm going to stop sharing my screen now. So you guys have been fantastic, and we've gone about 42 minutes, and I kind of covered everything quickly. If you need help, let me know. Put it in the comments. Don't be afraid to ask for help. I would rather you ask me for help, have me run it through 10 times if I need to, than you make a bad deal, because no deal is better than a bad deal. It really is, because you can't be paying money every month when you're trying to make money passively. Okay. That does not work. That does not work well at all. So ask the questions. Now is the time. Learn how to do this. If you need me to, I'll walk you through it 10 times if I have to. I love underwriting. The numbers don't lie. I don't fall in love with any deal at all. The numbers do not lie. Okay. I think that's everything. You guys got any questions for me? And I don't have any questions right now on the live. Well, it's a Friday night also, so I'm imagining that we're probably low on the live, and I'll get majority of the questions on the replay of it later on. But hit me up. I answer every question, every comment on my YouTube videos, and I'll answer whatever questions you have, and we'll walk you through it, and we'll teach you how to do this. We're gonna get you there. Okay. So let me know. You guys are awesome. I appreciate it. We love you guys. You guys have a great night. I'm gonna end the stream. I know. I'm sad too. You guys have been fun. You guys have been fun. Still think Michael Jordan's the greatest basketball player from the last live. Not gonna give up on that. All right. Love you. Bye.